Hey guys, happy Friday. Welcome to another episode of Real Estate Investing Explained with Enrique Huerta. Today's topic is the Savvy Investor's Guide to Net Operating Income and Net Cash Flow. This video will be a lot shorter because we've gone through all the details of total operating income and total operating expenses. What's left is net operating income, which I'll explain here, and then some more expense items that you must account for in your financial analysis. And finally, we get to net cash flow, bottom line, how money is made, how cash on cash is calculated. We'll talk briefly about cap rate, which is a measure of return on investment using the NOI. I'll be brief, and tomorrow we're going to dive deeper into those metrics for investment returns. All right. So today, Friday, April 17th, it's National Cheese Ball Day. Can't say I'm a huge fan of cheese, but nevertheless, if you like cheese balls, feel free to celebrate. Or if you are a cheese ball, then happy Cheese Ball Day to you, all right? Before I jump into 2011, on this day in 1810, pineapple cheese was patented by a gentleman named Lewis Norton. And pineapple cheese is not cheese with pineapple. That's probably disgusting. Although I do like that cottage cheese that comes with pineapple on the side. That's pretty good. But no, pineapple cheese was really just cheese that was put into a mold and looked like a pineapple. And that was a patented process, a mold. It became a really super popular gift, like a housewarming gift, that kind of thing in 1810. So if you were in the 1800s and you received a pineapple cheese, you were well respected, all right? So if any of you people on National Cheese Ball Day are getting pineapple cheeses, good for you. And then in 2011, on this day, that's the day that Game of Thrones was first released on HBO. So I remember just as early as last year, in 2019, people were talking about Game of Thrones, but it premiered in 2011. 8 years, man, might make you feel a little bit old, all right? Anyway, let's jump into net operating income and net cash flow, all right? So first things first, as we mentioned, you calculate your total operating income, and then from your total operating income, you're gonna subtract your total operating expenses, and that gives you the holy grail of commercial real estate, net operating income, or NOI. Again, NOI is just all your income minus all your expenses. That's your NOI, all right? And that NOI is really what investors use to value commercial real estate. It's what lenders use to lend on commercial real estate. And it's what you need to use to create your calculations and forecasting forward to really determine what a piece of commercial real estate is worth to you, all right? So NOI is the holy grail of commercial real estate. From your net operating income, you can derive what they call a cap rate. A cap rate is short for capitalization rate. And the best way that I can think of a cap rate is a free and clear return on your investment. So if you were to buy a piece of commercial real estate, a 300 unit apartment building, if you were to buy it all cash and you were getting a 5% cap rate, you would get a 5% return on that cash. So that's a metric that a lot of investors use to very quickly just kind of determine approximately, compare deals apples to apples, right? If you're looking at a deal in Texas, a cap rate will be X. If you're looking at a deal in Arizona, it'll be Y. And if you're looking at a deal in New York, it'll be Z. So X, Y, Z. And the cap rate is, again, a measure of return, right? It's your free, clear return on an investment if you were to pay all cash. But it's also a measure of your risk, okay? And what I mean by that is, of course, we talked about risk and reward. The higher your cap rate, the higher your return. But along with higher return comes what? Higher risk, okay? So high cap rates are good, yes, but you must understand why they're higher. And usually it's because your risk will be higher. So always when you see a high cap rate, don't get excited. Cap rates have been low in this market for a long time. The average I see in Dallas, Texas today for a value-add multifamily project is 4.5%. That is the cap rate on a project going in. In Colorado, they're usually a little higher than that. And then you can go to markets like the Midwest, where you can actually see cap rates closer to 8%, 7%, 8%. Not really in the space I operate in the smaller property space, but you will see higher cap rates, but again, higher risk, right? The demographics are different in the Midwest. The tax structure is different. The natural disaster risk is different. So you can get higher returns, but with those higher returns comes higher risk, all right? So cap rate, again, how do you get a cap rate? You take your NOI, whatever it is, it doesn't really matter, whatever the NOI is, divide it by the price you were gonna pay for that NOI for that property, and that will give you your cap rate, okay? So don't forget, cap rate equals NOI divided by purchase price. And again, cap rate is a free and clear yield. But that's just one metric, right? It's just one way to measure your return on investment. And most of the time, as I mentioned, one of the biggest benefits of multifamily investing is using leverage, borrowing debt, 70 to 75% in financing, to leverage your capital, your 25, 30% down payment, into a higher return. So your cap rate, while it is a good measure of a general return, it's not a measure of your true return. The measure of your true return is your net cash flow divided by the equity you invest, and that is your cash on cash return. And I'm going to show you how to calculate that real quickly. I don't have any numbers here. This is just a formula. I'm explaining it to you. Tomorrow we'll do an actual example start to finish. It's going to be a lot of fun. You're going to learn a lot. But again, cap rate based on the NOI, it gives you a hypothetical cash return, and then cash on cash accounts for leverage. You're not going to use NOI, you're going to use net cash flow after your leverage payments, and then dividing that by your down payment is going to give you your cash on cash return. So typically, if you're using leverage, your cash on cash will be higher than your cap rate. That's a given, all right? How much higher? That depends on the kind of leverage. There's millions of examples we can do. Every deal is different. But again, NOI, get your cap rate. You can stop there if you're going to pay cash. If not, then from your NOI, you subtract owner and entity expenses. What does that mean? What's an owner or an entity expense? If you buy a property, I recommend buying that asset in a single purpose entity, an LLC, a limited liability company. You have to pay to file that, to keep it in good standing. You may also have to pay an accountant to help you prepare tax returns, as well as do your calculations for your cash for the year, that kind of thing. That is an owner or entity expense. If you're a investment sponsor or you're self-managing, you might pay yourself an asset management fee that is subtracted out of your net operating income as well. And an asset management fee is related to but different from a property management fee. A property management fee is paid as part of the operating expenses of a property. Again, it's usually 2.5% to 5% on average, and that is paid to the property management company. They use that as compensation for their services rendered on site at the property level. An asset management fee goes to the owner or the investor or the sponsor of that investment, and they are paid typically anywhere between 0.5 percentage point up to 2% of either the total operating income or the equity investment. There's different structures. It doesn't really matter. What matters is if there's an asset management fee, you account for it, you subtract it from your NOI, and you pay that to the investor, the sponsor, the owner. Why are they collecting an asset management fee? For exactly that reason, for the work that is involved in asset management, which differs from property management in that property management is the day-to-day operations of a property. Asset management is more of a strategic, a high level, a portfolio level oversight of an investment. It requires a lot of travel, a lot of strategy, business planning, monitoring, tracking, reporting, etc. A lot of time spent in asset management. That is why asset management fees are paid. And again, you want to account for those after your NOI. So NOI minus owner entity expenses minus asset management fees. And then I talked briefly about yesterday capital expenditures. What are capital expenditures? It's any money you spend on improving the property in a non-recurring manner, okay? You replace appliances that are broken, that's a routine replacement. That would go in your replacement reserves, that would go in your turnover, or that would go in your repairs and maintenance as operating expenses. But if you make a business decision to say, hey, you know what? My property is great, but everyone has been asking me for stainless steel appliances. They're tired of the white, they're tired of the black appliances. They want stainless steel. And I've had people approach me and say, you know what, Mr. Owner, Mr. Manager, I will pay $50 a month more for stainless steel appliances. So if you make a business decision to buy, bulk stainless steel appliances, that's a major capital expenditure. And that's not something that happens every month or every year. It may happen just one time in your whole period. So if you were to put in your operating expenses, it will be misleading. And so what you want to do is extract that expense out and book it as capital expenditures, and it's not going to affect your NOI because it's not going to be a continuous expense, it's a one-time expense, but it will affect your net cash flow, so you must account for it, okay? So then subtract the expense for those stainless steel appliances, and then, and only then, will you have what I call an adjusted NOI. Or, in other words, instead of adjusted NOI, you can also call it NOI before debt service, okay? Or some people like to call it cash flow before debt service. But since I'm using net operating income, I want to stick with that terminology. So I have my NOI minus my owner entity expenses, minus asset management fees, minus capital expenditures. That's going to give me my adjusted NOI. And then from that figure, again, to calculate my levered returns, right, I'm going to subtract my debt service. What is debt service? It's mortgage payments, okay? So from my adjusted NOI, I'm going to subtract my mortgage payments or debt service. And that is going to give me my net cash flow, okay? So again, net operating income will give you a cap rate. It's a free and clear yield. It's a way to measure investment returns very quickly, but it's not the most accurate way, and it neglects your specific financial situation. So you want to take your situation into account. The loan you're going to get is a loan different than Bob's going to get, than Sally's going to get, than company ABC will get. So therefore, use your debt service payments to make the calculations on your returns and determine what your cash on cash return is, okay? And that's net cash flow. And that's really the money that can be distributed to yourself if you're the owner, or to the investors if you're an investment manager. And that's pretty much it, right? It's that simple. Total operating income minus total expenses gives you your net operating income. Divide that net operating income by the purchase price of the property that you're going to pay. That'll give you the cap rate, which is a free and clear return on that investment. But don't stop there. From that NOI, subtract the owner and entity expenses, subtract the asset management fees, subtract any one-time capital expenditures. That'll give you adjusted NOI, and then subtract your debt service. That'll give you your net cash flow. And then using that net cash flow, divide that net cash flow by your actual down payment, okay? Divide the net cash flow by the down payment, and that is your cash on cash return. That is a percentage on your money being paid to you as cash flow every single year. That's really, in my opinion, what matters. You can speculate, you can buy a property and hope and pray that it will appreciate over time. Yes, real estate's a great hedge against inflation. Yes, historically it's inflated. Given all the quantitative easing, there's been a lot of inflation and appreciation in assets that may not continue forever. But one thing you can count on that is durable, that is here today to stay, is cash flow. So in my opinion, you want to buy a property that has a minimum of a 5% cash on cash, right? That's the minimum. That's just going in. If you're adding value, that 5% will eventually be 8 to 10% or higher. And you also want to make sure you run some scenarios. In the worst case scenario, your cash on cash never ever goes below 4%. That's my rule. Do what you want. People buy deals in California with a 1% cash on cash, a 2% cash on cash, or even less. Everyone's motivation is different. I'm talking about being a cash flow investor. You want a minimum of 5% in year one or higher, and an average in reality of about 6, 7, 8% up to 10%, depending on the market you're in. And that's the guide to net operating income and net cash flow. With net operating income, you can calculate your cap rate. With your net cash flow, you can calculate your cash on cash return. And then using those, you can kind of run the numbers to determine what value you truly think a property has and what you're willing to pay for it. And tomorrow we're going to dive deeper into an actual mathematical example. It's going to be a lot of fun. You're going to learn a lot. So enjoy your weekend. Happy Friday. Happy National Cheese Ball Day. Hope you learned something today. And that's it. Have a great time. We'll talk soon.